Very strange. All right, so good afternoon, everyone. Thought we would do another cycle day review. Today will be a cycle day 1 review. Today's Thursday, April 9th. Before we get to the presentation, industry regulations require that at least we highlight compliance NFA rule 2-29. And you've seen this before. Just simply hypothetical results have inherent limitations. Trade money you can afford to lose. This presentation, in summary, is for educational purposes only, and past performance is not indicative of future results. All right, so what I thought it... Okay, hold on a second. I lost the screen share. One sec. Oh, I see what happened. I don't want to see that one. Whiteboard. Oh, interesting. Okay. Let's see. It doesn't show. Okay, share screen. All right. Okay, now I get it. It's not going to be able to share. Not going to be able to share both screens at the same time. Now that's disappointing. That's most disappointing. Okay. All right, so let's do this. I thought I would be able to share chart and the spreadsheet, but apparently Zoom is not allowing me to do that. So we'll do one step at a time then. I wanted to be able to share them both at the same time, but doesn't allow me to do that. It used to do that. Not playing ball. Okay, so everybody should be seeing the spreadsheet, and if you could just verify that for me, that would be great. Okay, we're in good shape then. All right, I'll just do it separately. What I wanted to do is have the chart side by side with the spreadsheet, but we can do it this way. We'll just call an audible. Okay, so what I want to show today is, first off, a couple items on the spreadsheet. And I've gotten a number of questions recently about how to read the spreadsheet, how to find the various numbers and so forth. So I thought we would do a short review on this. Yes, it is being recorded. And so today is a cycle day 1. And so on a cycle day 1, the normal would be for a probe to find a secure low. That's the job of a cycle day 1, coming off the completion of the prior cycle. So is to find a secure low. So some items that we want to be looking for is, and asking questions of, will be, what is the average decline that has occurred on cycle day 1 over X number of cycles. So in this case, we're going to be looking at 20 cycles. So 23-day cycles, which is approximately 60 trading sessions. So what is the average decline on a cycle day 3 that has occurred in the past? So that's the kind of the starting point for a cycle day 1, because we want to know what the average is, so we can determine whether or not the price action that is unfolding is in agreement with that. Is it, has it succeeded in achieving that average? Is it less than average? Is that more than that average, etc.? So on the spreadsheet here, what we want to look at is line 8, where it says possible low for cycle day 1, and you'll see here that it'll give us a couple numbers, 2642 down to 2640 for today, based upon the average decline. Okay, so again, over the past 60 cycles, or 20 average cycles, or 60 days, what has been observed is that the market has moved, if we move over here to the right, during the Globex 24-hour sessions, a total of 109.86 points. That's the average decline for the entire 24-hour session. If you were to take the RTH session, regular trading hours, individually, that value is 112. So between 109 and 112, they're both correct. So kind of think of it as a range, right? So a zone. So that's our starting point. And then as the morning unfolds, how do we can determine whether or not the market is unfolding normally or not. Now, how do we get these numbers? Now, there's the range. So how do we get these targets over here to the left? So this is measured from the prior high. So the prior high here in column P, so if you take 2752.50 less 109.86, because that's the average decline now, gives you over here on the far left 2642.64. Okay, so the average decline target is based from the prior cycle day 3, in this case, high. Very straightforward. Now again, you may not have understood where those numbers come from. That's where they come from. Okay, so that's our starting point. Now, we know that if the market opened weak below the prior day's low, so again, two big reference points according to Taylor were the highs and lows of the session. And the question becomes, was price able to exceed those levels, and by how much when that happens? And we'll get to that in a moment. But so for the average decline, that's just how we get it. So let's take a look at the possible low for the day. What that means is if price on cycle day 1 declined below the prior cycle day 3's low, the question is then, what does the average decline look like? Not the average decline from the prior high, but what we call the violation decline. So when we're breaking down through a level, it's referred to as a violation. When we're breaking up through a level, when price is breaking up through a level, it's referred to as a penetration. Okay, that's the terminology that Taylor used. So in this case, if price, so let me just clear the drawing off here. So if price violates the prior low, so what's the low up here? 2620 spot 75. What is the average decline, violation decline that is, that that has occurred in the past. So again, coming over here in column U, all right, we're looking at this area here where it says 77.54. So we take the 2620 spot 75 less 77 spot 54 gives us over here to the left in line 9, F9, 25.4321. Okay, so you take the low, because we're violating the low, a violation of the low, subtract the average violation, gives us the result of 25.4341. So that is the average violation on a cycle day 1 when price violated the cycle day 3 prior day's low. Make sense so far? So that's how you get that particular number. Let's clear the screen off one more time. We'll go the opposite side. So let's talk about the penetration. So on a cycle day 1, once again, kind of walk through that same process. If on a cycle day 1 price penetrates up through the prior high, so let's locate the prior high. Once again, 27.52.50. What is the average penetration range that has been observed in the past? So again, we're going to come over here in column U, and we're going to see that that value is 29.21. So add that to the high, and that gives you, in column F over here to the left, 27.81.71. All right, so the high plus the average penetration range gives us the target and what we call possible high. Do you always take the 24-hour low? It's the, no, you don't have to take the 24-hour low. If you want to calculate the 24-hour value, so there's two sets of values here. All right, there's two sets of values, and they're both correct, by the way. So if you decide you want to ask what the penetration high is based upon the 24-hour numbers, it would take the full session 24-hour numbers. If you want to say, well, what has it been for the RTH session only, and so you take the RTH highs and lows respectively. So in this case today, or yesterday rather, the high was the same because the high occurred last. The low is different from the RTH to the Globex or 24-hour session low. So that's different. So it's the starting point that you want to measure. One is not better than the other necessarily, it's just a different value, but the calculations are the same. So try not to get confused. You know, in one sense, I think of them as, okay, so this was the potential in the overall session. How is the RTH session doing relative to that? Remember, these levels do not, this concept does not imply that those levels are going to get fulfilled. This is not a prediction game. Rather, this is that if the market moves in this direction and triggers a penetration move to the upside or a violation move to the downside, what we're trying to determine is historically how far has it gone. And again, this is what this spreadsheet is designed to show us. Actual observations of ranges that have occurred under those specific day conditions. When a violation occurs or a penetration occurs on a specific cycle day, what has been the average extension or range away from the highs lows. Okay? So it's important, but again, they're both correct. It's just what your starting point is. I don't necessarily have a hard preference, though I tend to lean into the 24-hour session, only because it's more comprehensive. But I will say that what you really want to do is use both of them as a zone. So again, when you take a look at this for a moment, right? Take a look at the penetration high over here, right? So it says possible high for cycle day 1, 2781.71 in the 24-hour session and 2792 in the RTH session. Think of that as a zone potential. Prices can move up to the 81.71s, up to the 92s. All right, so I always kind of think of these as a zone. I kind of lay them out. So on the violation side, prices can decline on an average violation between 25.6988 down to 25.4321. That's how I view it. That's how I've learned to view it, working with this over the years. It's a zone. And as our members know, I've always talked about it's never one level, it's always a zone. So when you have a zone in mind, that's the zone potential. Potential is the key word, not predicted zone, but potential. Now, today is a little bit different in that the decline that has occurred throughout the session, and we'll go to the chart in a moment, the decline that occurred throughout the session did not even come close to the average decline. When that occurs, when this kind of scenario occurs on a cycle day 1, a decline did occur. So one of the ways you want to view a cycle day 1 is we're expecting a decline, some magnitude decline. The average decline measures X, and we'll get that from the spreadsheet. We are expecting some sort of a decline. Now, if you recall the prior cycle, there was no decline. Right out of the gate Sunday evening, the markets moved higher, and that was a cycle day 1. Today now is a new cycle day 1, a little different. We did get a decline. It was much less than average, and the market has proceeded to move beyond the prior highs. So the bullish condition remains in effect. Everybody's good with this so far? So today was less than average, bullish formation, and then actually price went up and penetrated above the prior highs. Now again, the initial targets here, 2781.71 up to the 92s, that was the initial target. The way I look at this, these are the average initial targets. Now over here on the far right, I want to bring in a concept called standard deviation. And what this basically, so we're going to be looking at columns X and column Y. So again, 24-hour session and RTH session. So what do these represent? These represent the distances, or the standard deviation distances, that have been observed, once again, all actual observations, when the projected possible high, in this case 2781 to the 92s, were exceeded. So think of this as a new level, and then the question is, when on those days that these levels have been exceeded, how far have they been exceeded by? It's the same basis question, is if it's penetrating up through the prior high, these would be the projected targets. But on occasion, when those targets are even exceeded beyond that, well, what has been the observed distances or ranges above that initial targeted level? So over here in columns X and Y, all right, you'll see the values, in this case 20, 27, 17, 81. So what this means is you take the 27, 81, 71 target over here on the left, which was the initial projected penetration target. If that gets exceeded, what would then be the next projected level? So now you would just simply take the 27, 81, 71, and again, you can round these fractions off. You want to add the standard deviation in the 24-hour session, which is 20.27, and that gives you a result of 28.0198. So call it 28.02. Everybody follow so far? So this is how you would, on days, now this is not always going to occur every day naturally, but on those days that it does, and you would do the same thing, 27.92 plus 17.81, or round it to 18, okay? And those are the values you'll get in what we call the standard deviation, or I just like to refer to them as the extreme observed levels. Okay? So the odds of a decline in the top right. I don't use these a whole lot, be honest with you. But essentially what it means is, in the normal days, prior to all the highest volatility that we're currently experiencing, look, we're experiencing 108 point ranges. So these values up here where it says odds of a decline greater than 10 handles and then greater than 20 handles don't really apply at this stage. When the VIX was in the teens, prices were, to get a 20 handle range day was pretty awesome. You get 20 handles in about 20 seconds today with the high volatility that we're having. So the odds of a decline, if you were to kind of think back and take a step back a few months and say where the VIX is in the teens. So the odds of a decline greater than 10 handles was relatively high at 73%. The odds of a decline greater than 20 handles, right, was about 50-50. Okay? So again, that was back in the day when the VIX was very low. So so these don't really matter a whole lot at this stage. So I don't even look at this because it's irrelevant at the moment now. All right. The average range on a cycle day one, would you please go over that as well? So the average range is just simply that. The average range simply means that the range of the day, the high-low range. Okay, so let's take a look at the high-low range here. All right, 27.52.50 minus 26.20. All right, spot 75. So what's that? 131.75, correct? 131, so call it 132. I like to round numbers off. So 132 point range. Up to and including today, or yeah, well, it's not including today, by the way, because today is, well, one step back here. I'm actually measuring the high and low from cycle day 3. But what you would do is you take the high-low for the past 20 cycles on a cycle day 1 is what you're getting here, is your average range, 107, so 108 points. I like to round. So that's how you would do it. You would take the high-low range, right? So today's high-low ranges, okay, so today's high-low range today will be added on to the current values for cycle day 1. And then this number just continues to change, all right? Can those average ranges be smoothed exponentially? You can. These are simple averages over a 20 period. These are just a simple 20 period average. And that's all what we're measuring. Can you apply exponential and beef them up a bit? You can. I don't think it's necessary, not in a case such as what we're trying to track. A simple moving average of 20 cycles has been adequate for us. I don't think that beefing it up using an exponential and smoothing it and doing all the other things. But it's something you can do. I mean, you would need, in order to do that, certainly you would need to have the data streams, you know, the raw data in order to do that. Or you can create your own for that matter. You know, you can create your own spreadsheet, and many actually have, you know, they like to, you know, do things somewhat on their own and kind of customize items. These sheets are not customizable. But I've seen people, you know, if you wanted to take a 20 cycle average of a cycle day 1, so you would have to go back and see what the ranges were every cycle day 1 and apply a smooth exponential moving average to them and see what that value is. My suspicion is it won't be too far away, at least significant enough where it's going to make any real difference. So in that case, you know, but yeah, you could do that if you'd like. So what I wanted to show here, and again, kind of the core of this. All right, so here's a question. So now that we are at 2811 as we speak, is this telling you that we essentially have another 10 points to the upside at 2821 on the day session? Okay. So on the day session, what do we go? So let's take the numbers. Let's do that. So the session high projected, right, was 2792, correct? And we'll just call it 18 points. Plus 18, right? So now we're going to come all over here, and we're going to add, call it 18 points. And that brings us to 2810. All right. So now that we're at 2811, so we're right at this upper statistical edge. Okay? Is that where we currently are? We're like at 2808 or something, right? So we're very close to the upper statistical. So the two statistical edges was the 2781.71, right? Plus in the 24-hour session, so that gave us about 2802. So between 2802 and 2810 basically is our upper edge of the statistical range. That has been observed on a cycle day 1 when price has penetrated up through the cycle day 3 high. Now you may want to review this video a number of times, okay? It's different than the statistical extreme zone that we have laid out. It's a different calculation. So the stat X that we have in our normal uh, indicator package is based differently. That you can think of it as a statistical extreme in that regard, but it's not the same calculation as the X zones that we actually have that you've seen. So it's a totally different calculation. But this is the extremes, statistical extremes or standard deviation extremes that have occurred on a cycle day 1 when price has exceeded or penetrated the cycle day 3 high. So today is a bullish day. Now remember, the goal here, number 1, is to establish a low. So it established a low early around 2700 if I recall this morning. Then so the question was early, somebody had asked, well, is this a secure low? And we don't technically know that until the end of the day, but we can clearly make an assumption. So part of trading is making inferences and assumptions as to what is unfolding based upon the observations of what we're seeing. If you're waiting for a confirmation each and every time that the cycle day 1 low is in place, we may miss some opportunity, throughout the course of the session. So the idea this morning was, to the answer to that question is, we don't know that for a fact yet, but we could probably make some pretty good inferences that that's probably going to be a secure low. We didn't know that, and we still don't know that because the market, may take a nosedive, at any point. We don't know. But that said, we have to make some judgmental, decisions and inferences about the action. And so this morning, 2700 looked pretty firm from the buy response that occurred, and that's all what we really need to know. And I also mentioned this morning throughout the session is, and regarding the cycles, such as today, don't overthink it. That if the cycle high was made first or low, I really, over here where it says, the cycle day 3 high and the 3 low is made first or last, I don't really pay a whole lot of attention. I don't put a lot of weight on that. How prices close is more important to me as to whether it was made first or last. So I don't really place a lot of emphasis on it. I'm not sure how much emphasis Taylor himself placed on those, that observation, but I don't place a whole lot on it. Again, just my personal preference as I've used this throughout the years. But rather, I want to say, definitely if the price pushes through the highs or lows, well, I want to know what the potential is, because if there's pretty good range potential in the market as it's unfolding and live action is showing us other internal strength in the markets, then at least I know what the potential is based upon this method. It's not an estimated Fibonacci or Mori math or things like that, which have their place. But based upon this, to me, these are in fact observations that have occurred, and that's why I believe this is a superior way of viewing the markets comparatively to those other methods. Those other methods are estimates. All right? And these are observations that actually have occurred. Right. They're based upon actual averages, not estimates. And that's the difference. And I would rather base my decisions on actual observations that the market knows and has done, has created. Okay? On the chart, can you please show how it's more important for you, how the price closed rather than the numbers? Well, the numbers, you mean rather than whether it's occurred first or last? It's all about momentum when it comes down to that. So If everybody's good with that, let's take a look at this visually. All right, so we wanted to dig in to see how the spreadsheet, how you actually get the numbers. And we're using just the S&P as the example here, but if you were to do it with NQ or YM or Russell, it's the exact same formula, exact same levels. You read it the exact same way. All right, so know one, know them all. How to do it. Very, very straightforward. Okay, so this is how you would do it. And again, particularly for a penetration level or a violation level, regardless of what day you're on, 1, 2, or 3, it's the exact same way to calculate it. So the values over here to the right will be what they are for that particular day, and you're still going to take the measurement from the high, the low. You're going to subtract it. You're going to, add it. You'll get those levels and numbers. Okay. So let's take a look at the chart. I wish we were able to do this, kind of split the window side by side, but apparently Zoom didn't like to do that. So we'll have to work around that. So let me put up, 1 second, let me put up the chart, and let's see what we can look at from the chart itself. Okay, so we've switched over to the charts. So you should see one chart here, 60-minute chart, cycle day 1. And so some of the items that we want to identify here. So number 1, well, let's identify the cycle day. So let me just mark these here. Okay, so this is CD1 over here to the left. This is CD2, and this is a 24-hour session, by the way. This is CD3. And then now we're back on, right, CD1. So this gives us a good look of the cycle. There's nothing like testing your code in production environment, I know. All right, so so we're talking about CD1 here today. So a couple items, again, we've already gone over this on the spreadsheet, but visually, I just want to be able to show you, how it looks with the indicator. The indicator just makes it a lot easier to see. Once you know what the spreadsheet offers and how the numbers are derived, you don't really have to stare at the spreadsheet all the time. All right, using the indicator, you can get these values, and it's right there on your chart, so it makes life so much easier. But so number 1, you got the cycle day 3 high here. All right, actually that blue line right there. Okay, so the cycle day 3 high. So if we were to measure, okay, if we were to measure from the cycle day 3 high down to what the average decline measurement was, remember it was between the 42s and 40s, right? So that measurement here, if the market declined on the cycle day 1 to the average decline, there it is right there. So we just have it laid out on one of them, 42.50 basically. So that white line indicates visually how far price would need to go and what the average decline would be on that day. Well, today, cycle day 1, actually we already know that price did not, so price did decline. Actually, price went up a little bit, penetrated above the prior high, got rejected at the initial penetration level, and was rejected, and price pushed down. I guess there was non-farm payroll numbers this morning, right? So, but if you look left, and this is important now, this has nothing to do really with a cycle, but rather knowing where inflection points, we've been talking about this the past few days as well, knowing where inflection points are, where prices change direction is a flexion point, inflection point. So if you take a look here on cycle day 2, where was there an inflection point? There it is right there. X marks the spot. Prices were holding highs, they dropped down, they recovered, and then they finally broke. And that's when we saw that aggressive move into the close the other day. Coming into cycle day 3, and again goes to Alan's questions earlier about, what was your question earlier about the, if you want to repeat that question, I can't remember exactly what it was. Well, oh, wait a minute, I'll find it here. On the chart, can you please show how it's more important for you how the price closed rather than the numbers? Yeah, so here's the thing. So how the price closes is important. So if you take a look at cycle day 2 the other day, prices closed very weak near the low of the session. Typically, the normal expectation then becomes on the next day, if prices have closed very weak, in this case low in their range, the expectation would be for a continuation to some degree, and to that degree would be to one of the violation levels that would have been calculated on that day. So it's important to, you can make an assumption that prices may go further. In this case, in this example, we're talking on cycle day 2 into cycle day 3, that prices may go lower. But there's also the chance that it won't. And so, again, our observational skills, instead of just saying it's going lower, we don't want to say that. We want to remain flexible. We want to say it may go lower, and if it goes lower, I have some levels that again, those violation levels based upon the spreadsheet. What's the average decline of violation decline, or the average penetration? So this is where you want to, instead of making guesses or emphatic statements that it's going to do this or it's going to do that. Market's going to do what it wants to do regardless of what we say. But by using this as a guide, by saying, okay, prices closed weak into the near to the lows, in this example here on the prior cycle day 2, we can make an inference that prices may go lower on cycle day 3 or into cycle day 3, because cycle day 3 is a long day. But the initial move, and that could be in the Asian session, could go lower. But what happens if it doesn't? So remember, I'm always writing 2 scenarios. I'm writing a bullish scenario and a bearish scenario every day in the daily trade strategy. And you ought to think about the market in those terms. Bullish and bearish scenarios. That will give you flexibility to say, if it goes lower, these would be the targets. If it goes higher, these set of targets would be considered. Which direction will it go? I don't have a clue. But it doesn't matter, because my job is to be able to read the market's action to what it's doing rather than what I think it should be doing. And again, if you adopt that type of mindset, you're going to be so much better. You'll be able to stay flexible. So looking at cycle day 2 into cycle day 3, yes, it could have gone lower. But observationally, what happened? Prices actually bounced on cycle day 3, came back down, and this was all during the Asian Euro session. It held lows here. And then as we entered into the US RTH session here, prices moved higher, and then once they took out that reaction high over here, that was in the overnight, so at the time that was the overnight high, not the cycle day 2 high, the overnight high on cycle day 3. Once that happened here, right, you saw some volatility between these two 60-minute candles, and then once it was able to clear that level, clearing and converting it, it was off to the races for the rest of the day, all right, into the high of cycle day 3. Okay. So considering you know the idea of the importance of whether the market continues on or not, we have to observe whether or not a violation or a penetration has taken place, in other words, expanding that range. Okay. So clearing converting. So at what point did that happen? So the idea of a clearing converting is you take a pivot high, in this case over here, all right, where I'm circling. That was known, and I don't necessarily like to use the word resistance, but that was the last point from which the buyers paid that high price. That was the last buyer at that point before the market pulled down. Okay, and then found again support, or where the last seller sold at that moment, and then buyers stepped in again. So as buyers stepped in again, came back up to that high, prior known high, there was some backing and forth there. I think yesterday I called it rock'em sock'em robots or something throughout the day, throughout that period. So remember, these are 60-minute bars, so there's a lot of action between the two. Once the price clears above it and closes above it, or is able to stay above it. So think about one of the examples I quickly use is in football, right? So point after touchdown, you can either kick it or you go after the 2-point conversion. So think of it that way. In order to convert, what does the ball need to do? It has to get over that line and has to stay there, in essence. So think about a 2-point conversion. So in terms of trading, the conversion is it has to clear that line, that prior known resistance level, all right, and it has to stay there. Okay, but Michael, so thinking about in terms of just what it needs to do, all right, it needs to get past that prior resistance point and stay above it. That becomes a conversion. When that occurs, then everybody trading, everybody waiting to trade, everybody looking to get in on it will start coming in, because they're seeing that the market that had resistance at a level, there's no more resistance. This is why I use the phrase, buyers are higher. And a lot of people don't understand that. Aren't I supposed to buy low and sell high? But in fact, buyers are waiting to buy once they have seen that there's no more sellers. Once they can confirm that, for themselves that there aren't any more sellers, or at least sellers strong enough to push it back down, then they want to buy them, because then there's open air to the upside. That's when there's actually less risk inherently to buy them when the sellers are complete, because the expectation is more buyers are going to come in and it's going to push prices higher quicker. That's why a lot of people like buying breakouts. But that's a different topic from what we're discussing now. But once prices have converted above a level or below a level, all right, then the markets can move more freely. Michael says, I see a lot of instances where that happens, and they'll allow the repeated closes above that level, and then it gets smacked down. Again, there's a battle. Think about it. It's a battle line. In many cases, it's a battle line. You got those that want to keep it below a level, and you got those that want to move it above a level. And there's your and that's why I call them rock'em sock'em robots, because the inherent comment there is that it's an important level that needs to get cleared out. But once they're able to clear it out, then the markets move, a lot more than normal. Okay. Alan says, can't be more agreeing with that. So I'm assuming you are agreeing with that. But how do you distinguish this good breakout and really being so high and get a bull trap and being the last buyer? So I'm not sure exactly what you're asking, but how do you distinguish that it's a good breakout? Volume. Okay, volume is fuel. If price is breaking, again, this is a whole different topic, but we'll talk about it here for a second. All right. If price is breaking above a level and there's not fuel, so volume is fuel. If there's no volume in that direction, or if the market internals, the advanced decline line, for instance, is not supportive of that move, then it could be a bull trap, very simply. All right. What happens is people try to anticipate the breakout, and this is where the people that do that can get trapped. Now remember, you got two forces at work here at a breakout point, at a key breakout point. So those that want to keep it down, those that want to move it higher. Well, who's the stronger? Again, who's the stronger party? Well, those that have the most fuel, those that can produce the most volume and clear out the volume. So in order for a breakout to happen to the upside, the buyers have to whatever the available supply is at that time, they have to absorb that and extinguish it. So volume, you got to track the volume very closely during breakouts, during those key points, because if prices are just probing above a high and there's not really a lot of associated volume with it, then it's, and you're just, and you're anticipating that happening and you buy it, and you haven't really seen the supportive evidence for it, you could get caught on the long side, and then it's a bull trap, and then they push it right back down, and then you're stopped out for a loss. All right, so a lot of people like to wait for that volume to accelerate, because if there's expanding volume to the upside, well, certainly that means there are sellers there. But if the bids are bidding into the offerings that are for sale, and the volume is expanding to the upside, what does that suggest to you? It should suggest to you that the buyers are aggressive and they want to buy those contracts, and they're willing to pay that price for those contracts. All right. So again, there's some anecdotal evidence that needs to happen. All right. So Michael says sizable volume at a point like that, in his experience, is usually going to reverse the trend. Well, if it's a breakout, okay, remember, the volume has to be, whatever's for sale has to be cleaned out. If there's a lot of volume into a level and prices stall, all right, so think about it there's aggressive buyers, all right, so like at this level we're talking about, there's aggressive buyers, and the volume is expanding to the upside, right? So people are out there, they're buying the offering, they're paying the offering, and there's sellers there selling it, but the price doesn't move a whole lot and the volume explodes. Well, again, we still got a battleground there, right? We got new longs, new buyers that just bought long. You got sellers that are selling their longs. But if that doesn't move that doesn't move. If the sellers are more power, in greater quantity, and the buyers are not able to clear out that volume, sure enough, you're going to have trapped longs. So yes, in one sense, volume is required for a breakout. But the nature of that volume, you got to watch that still closely. Because just because there's increasing volume doesn't guarantee the breakout, but it is a component of a breakout. All right, so again, the idea of being flexible when it comes to these points in time, all right, is important. Again, I don't want to get too far off the topic, but my point here was, the prices cleared through that level, a conversion of that level, and once the market was satisfied that that level had no more supply, buyers come in, all right, and continue to move. Yeah, that could be a discussion for tomorrow as well. So be sure to have your questions, by the way, for tomorrow. Anyways, coming into, let's move ahead. We just got a few more minutes here. I want to finish this up. So today, again, cycle day one, we found the low at the 2700s, as I mentioned, and then prices penetrated back up through the cycle day 3 high during the RTH, regular trading hours session. And it did move up to the average penetration level, right in here, right, 2781.71, which we saw on the spreadsheet. Now, the next level, all right, which was the standard deviation level, which is basically the 2802s roughly. And that's the top of this red zone here that you see. And you can see that the prices did stop there, right, for a period of time. So that validates that level. Now you can see right now in this last candle as we're speaking, we're right into that next, the RTH, which is not shown here, the RTH standard deviation level or extreme level, which was it? We measured it to 2810s. So we're at 2808. So basically we're at the next kind of key point. At this point, there is no other, based upon the cycle observations, there is no other level above this. So the market is pretty much on its own. If it's going to continue on higher, it's pretty much on its own to do its thing. But it is a bullish cycle day one, and we want to treat it as such. Just because it's at the extreme level does not mean it has to reverse. But we want to be sure it is an important, price is at an important juncture. For the bigger picture, I believe we're into this 50% retracement zone from peak to trough on the daily basis. So again, there's going to be a lot of, activity going on here over the next probably, well, we're into the holiday at the end of today, the long weekend. But again, we're at this inflection point. Even though we're at this inflection point, you want to maintain the bias as long as the structure holds. Don't just say, okay, the market's going to reverse here and we're going to go back down, 5 or 10%. It may, but we'll deal with that on another day. As of today, right now, we got a cycle day one in bullish momentum. Price is at extremes, or again, observed extremes for the 20 period cycle, and that's all that we know. So before you start making any, predictions about what things will happen next, observe what is happening, observe that prices have reached projected range targets based upon cycle observations, and that's where we stand. And that's going to conclude this review of the cycle day one. It's a little bit different cycle day one. We didn't get the full decline. We got a relatively shallow decline which found support at a prior known level. and then prices then proceeded to clear the prior cycle day 3 high, penetrate, and then this example here, which was the market is a great example, it actually pushed up into the extreme observations. So this is still a normal cycle day 1 from the standpoint of we did get a decline, all right, and then the rally began. So this low here near the 2700s is going to be, excuse me, more likely the secure low for, you know, the day. I mean, it's almost a foregone conclusion at this time of the day. All right. And we did not have a sell day on cycle day 3. A sell short day, you mean? Sell short day? Yeah. So cycle day 3 is normally, you know, you sell it, and then the idea is to take some profit. They may have done that somewhat, and I alluded to that on cycle day 2. Because remember, this prior cycle even went well beyond the norm. So that cycle day 2 may have been a day where they sold longs, perhaps initiated shorts into this drop into the close. No further selling came into, you know, follow through. And then cycle day 3 actually perhaps was a day where it was, and again, I'm kind of just looking back at this and kind of backfilling a little bit, but cycle day 3 could have been, the strength on cycle day 3 could have been some short covering against cycle days 2's, you know, potential layout of some shorts. You know, again, we're trying to make some sense and some inferences here. You know, I don't know for a fact. All I can say is, you know, that the market continues to be in a bullish pattern. How that, you know, how people out there, whether they're shorting or going long or covering shorts and whatever they're doing, mixing their positions, doesn't really matter a whole lot to me. All right. I mean, I can make an inference and that's fine, but even if you make an inference, make sure you're flexible enough to change that inference. Okay. Could you define a secure low, Doug asked. Basically, a secure low is once that low is in place. So today on the cycle day 1, if it's tested, and it doesn't have to be tested, but typically lows and highs tend to get tested. But a secure low is a low where, if tested, does not break. All right, so if tested, does not break. And that is, so for instance, this low over here to the left, right, these pivot lows, what happened to these pivot lows here on cycle day 3 that I'm pointing to? Prices came down to that level, call it 2700, 2710. It was tested over here, so these pivot lows. So that reinforces 2700, 2710 zone as support. So we can then make an inference here today, based upon that evidence today, that today's cycle day 1 low is secure. We don't know for a fact until the end of the day, and we're mid-afternoon here, but with pretty good confidence that even earlier this morning, that more likely is a secure low, based upon that it actually tested a prior pivot level and then held here, being that it's on a cycle day 1 low, or cycle day 1 creating the low, we can make a pretty good assumption that it's secure. But the technical aspect of security or surety is for some sort of a retest. But it doesn't have to retest. But in most cases, the normal kind of sequence is to retest the high or retest the low. And the reason for that is they want to find out whether there's buyers or sellers below that level. And that's the idea of a retest. And that's the idea of determining whether or not a level is secure or not. Once they feel as though, and they get the sense that, and they're confident enough that it is secure, then they take definitive action. And that's the idea of deciding whether or not a low or a high is secure, because they need to take definitive action. All right, guys, I'm going to end the formal presentation here. We've gone about an hour and 5 minutes. We'll have this rendered, recorded, and uploaded to not only the website, but we'll give you, we'll have it ready for everybody tomorrow. And again, tomorrow, Friday, Good Friday, we are holding a Q&A session. So be sure to come with questions. Whether you want, if you'd like to write them out first and send them off to us via email, you can do that, or be prepared. And if you have audio capability and you'd like to ask a question verbally, we can do that as well. And we'll do it in the Zoom room as we're doing it like today. It'll be 10 p.m. Eastern Time, correct? Okay, and we'll just keep it flexible. It will go no further than noontime. So we'll give 2 hours if we need it, and it's all going to be dependent upon the level of questions and so forth we get. So if you have questions, if you have troubles in an area, and you can email me questions if you'd like ahead of time. That would be great, because I can prepare kind of an initial response to some of the questions if you have. And again, you can ask about the method, you can ask about the educational program, you can ask about anything related to the markets, right? And I'll do my best to give you the best responses possible. All right, let me shut this down, and we will continue on in a moment. And if anybody would like to reach out to me and have any questions, you can reach me at david@polaris.tradinggroup.com and visit us at www.polaris.tradinggroup.com. And thank you for viewing this review of Cycle Day 1.